Time for the word on Wall Street. Top investors watching your money. Joining me now, Bull Tick Capital Markets Chief Strategist Kathryn Rooney Vera. Kathryn, let's kick things off with you. Futures are trading higher this morning. Wall Street attempting to rebound from last week, which was for the Dow the worst week since last October. Of course, last week's Federal Reserve decision and inflation fear is still driving markets and investors. What is your take on last week's Fed decision, how it's impacting markets? Because, again, overnight you've seen money rushing into treasuries, and at one point in the last 24 hours or so, the 10-year yield was back below 1.4%.
Yeah. Look, Diggin, I think the Fed was very clear with its exuberance with regard to the economic recovery. The economic recovery is spectacular. They upgraded their economic forecast for real GDP this year to a whopping 7%, reiterating that potential growth is a mere 2%. While Jay Powell as well said, look, employment is going to skyrocket, and he's very bullish on the labor force and employment outlook. But yet they kept all emergency measures, right? So I think the market, even today, as futures are higher, the market's saying, we don't believe you. We don't think you're going to be that hawkish. So my suspicion, Diggin, is that the Fed is going to let inflation run. I do not think there's going to be tapering for the foreseeable future. And I think the Fed is between a rock and a hard place. I think investors, Diggin, need to really position their portfolios for the structural component of inflation, which I suspect could run into the transitory component. The transitory, of course, being base effects and shortages, base effects being far easier to forecast their end than shortages. But then you have the structural component, which is multi-trillion dollars of additions to a deficit-funded, government spending plan, as well as monetary stimuli that has far surpassed its expiration date.
Kathryn, before we move on, how do you play this then? Where are you allocating money?
So there are sectors that I like that historically have outperformed in real inflationary scenarios, not the temporary, transitory ones we're looking at right now. So those are, of course, energy, real estate, materials, utilities, staples. Those are the top picks going into next year. I suspect, Diggin, that technology is going to have a less strong year next year than this because of higher taxes and because of higher inflation and rates. I'm recommending going long on commodities. Commodities have taken a very nice hit over the past week because of this blip in terms of hawkish sentiment from the Fed. So go long gold, go long base metals, go long those commodities. I even like Bitcoin. Bitcoin dropped to what, 30, 32,000. It's a hedge. That's all it is. Have a small position in your portfolio, grow it if you already own it in that alternatives position portion of your portfolio. It has low correlation with traditional markets. I think we're in for a doozy in 2022, Dagan, and my bet is that the media and the headlines are going to start talking about stagflation over the course of the next 12 to 18 months than this, euphoric bubble that we've been living in that's been Fed and federal government induced.
Right. I wonder if that's what's already showing up in the 10-year, quite frankly. That people are buying treasuries on a weak economy. But thank you, Kathryn Rooney Vera and Michael Lee. Ryan Payne, you stay right where you are.